Welcome to this month's briefing for Three Corners Capital. I'm Chris Flores, and glad you're listening in today. Our goal for these briefings is to hit on things that we're seeing in the news that we think clients might be interested in, and bring perspective that maybe isn't something that you've heard before. So I want to kick things off today by just sharing a headline around giving that I thought was interesting, that I saw in the Wall Street Journal. The title was "How to Avoid the Tiny Tax Blunder That Cost Two Donors a $665,000 Tax Deduction." And ultimately, it had to do with a little line in the gift receipt that they didn't provide with their donation. And what I thought this article underscored was the importance that good advisors can play in a client's life. A lot of times you see things out there like, why do I need an advisor? What's the value of an advisor? And while sometimes we deal with things that are not on an everyday basis, when these big, especially these big types of giving transactions occur, it does help for us to be able to sit and aligned with our clients and think through the various things that would need to be made to fulfill a gift. It also reminds me of the fact that people make mistakes when they don't understand the full context of how various rules work. For example, we've run into situations where people have made gifts to donor advised funds thinking that it's not an irrevocable gift. Or, for example, we've seen people gift appreciated stock, but it was not held for over 12 months, and the rules around the tax deduction are different. So for a short-term shares, you only get the basis deduction, not the fair value deduction. So all of that gain that you were trying to gift, you do, but you don't get the deduction on that fair market value. Whereas if you've held it for 12 months, you get the deduction on the full fair market value, and you don't have to pay tax on the capital gains, and neither does the charity. So there's always times in a client's life where we do feel like it's helpful to have a discussion around are there gaps or opportunities that maybe have been overlooked. And even as we go into 2026, we're talking to clients about the new $1,000 per person above the line charitable deduction for those that are standard filers, which is most Americans. But a lot of people don't even know that that is a deduction that they're eligible for. Now, hopefully, if they're doing taxes themselves or they're working with the CPA, they're finding out that as part of the the question ask and answer process. But again, something we want to make sure clients are aware of. So hopefully that's helpful. The real tip and trick there is just, if you're thinking about gifting, whether that's to people or to charity, check with us. We want to help clients be generous, and we know a lot of ways that we might help you be able to be tax smart and avoid some of these blunders that exist out there. Well, I think one of the things we wanted to transition to this month was talking about some major economic headlines. Obviously, what's happening in the Middle East continues to persist. What's happening in Ukraine with Russia still exists. There's lots of geopolitical tensions that exist still. But some of the headlines more recently have been centered around the impact of all of this on our economy. But before I dive into that, one of the things that has been a headline is how the United States has hit 100% GDP or debt to GDP, which is a concern. And this slide will underscore this. The last time we've been as a country over 100% debt to GDP was in 1946 after World War II. And this is obviously causing alarm for a lot of people. We have to service this debt. It is a symbol of health, just as as we look at our consumers like ourselves. We want to make sure we're not indebted too much, because that indicates to the world that maybe there could be an issue. I think for us, what's important to remind ourselves is some of the things that helped unwind that high debt situation post World War II was strong economic growth, inflation, and productivity. Those are some of the things that we're seeing now. And we're, in terms of economic growth, we're seeing productivity gains. This is maybe something where AI could help progress. So I think it's also important to remind ourselves that there's an interconnectedness with a lot of different variables that on the surface could actually help with this issue. But nonetheless, it does underscore the importance that there will be some very real political decisions that need to be made as we evaluate, the long-term implications. But before you get too alarmed, I also wanted to share a couple of slides that I think are helpful to put that ratio into perspective. And this next slide talks about interest payments as a share of federal tax receipts. And what you can see looking back to the 1950s is while the interest payments as a percentage of or as a share of the total tax receipts has increased, we've been through periods where that interest payment was much higher than what was being received. And another way to look at this is in this next chart that shows current tax receipts in the green line, and then the blue line represents the current expenditures in terms of interest payments. And again, while there's an increase in the current interest that we're paying in our current debt, the overall tax receipts have increased commensurately, and that's symbolic of a somewhat relatively healthy dynamic, but it's obviously something that, again, we can't ignore. It will require adjustments to impact our country more positively long term. In terms of the overall health of the economy, the other thing that we're paying attention to, and we do on a monthly basis, are the leading economic indicators. The conference board puts out some really interesting research on an ongoing basis around multiple leading economic indicators. And for those that might be asking, what's a leading economic indicator? These are the things that are symbolic of where the economy might be going. Some of the things that we follow are lagging indicators, meaning how the market or the economy is moving is lagging after that piece. These are some of the things that are helping lead it, and a lot of it is tied to manufacturing and housing and things like that. And what this chart shows is that we've been in a decline in terms of these leading economic indicators. And for a lot of people, this would be a sign of a recession. Historically, this has been one of the better barometers for a recession, but we have not been in a recession, or at least one that's been declared. And this, I think, chart underscores a conversation that's been happening for a long time now, which is defining what we've been through as a rolling recession, meaning we haven't experienced a recession across the board as a country, but that we've had different parts of our economy experience mini recessions within those, kind of those different places. The other piece, we wrote about this a long time ago, but in the fall of 2021, we actually saw negative GDP growth, 2 consecutive quarters, which people were like, well, geez, isn't that by definition a recession? And again, ultimately recessions are outlined and determined by a group of people. And so just because somebody didn't say we were in a recession doesn't mean we actually haven't been through periods of time more recently where there have been a recession. I think a helpful chart that that the conference board puts out is it looks at 6-month growth rate. And what you can see is in 2021 and into 2022, we did see a very real decline. That was when we started to see inflation. Obviously, going into 2022, we had Russia invade Ukraine, which created energy issues as well. Compounding matters, inflation, and interest rates spiked. And that was really problematic. And you can see that the conference board's index flashed recession, although we again didn't see an official recession being indicated. And the positive thing, while it's kind of flatlined here more recently, is that we're actually beyond or surpassed where historically the leading economic indicators from a 6-month growth rate would show us being in a recession. So this could be an underlying positive, although I guess there are still things to be mindful of. The other thing that I want to make sure we talk about a little bit is sometimes our conversations with clients can be a little bit positive or optimistic. We never want to come across Pollyanna, meaning we're not trying to look past the hard realities. We just talked about the debt. That's a real issue. There are different parts of our economy that are struggling. And one of the things that we are paying really close attention to is the health of the consumer. The news headlines have called this a K-shaped economy. There are people, the haves and the have-nots. There are parts of our economy that people are really, really struggling, and we're all experiencing cost increases. But some of us are able to better weather that than others. And this chart that we've shared in the past really underscores this. It looks at cohorts, so income groups, and what this shows is that 80% of Americans their income is at or below their spending. Now, some people could say, well, geez, couldn't you cut some costs here and cut some costs there? And perhaps that's the case. But what this really underscores is just the challenges that a lot of people are facing, where their incomes, are not able to keep up with the expenses, and inflation is a factor in there. What this shows also is that 20% of Americans are making more than they're spending. Where I think this is something that we need to be mindful of is our economy really has then been driven by a small group of people. And for our economic output, also referred to as GDP or gross domestic product, 70% of that is consumer spending. And we need to ensure we have an economy where all people can participate to be really effective. So if only a small group of people are really in a position where they can continue to spend, that could be problematic, especially if we start to see pressures on those people. I had several conversations recently with some pretty successful people that are doctors and other highly compensated professionals, where they're even going, well, I got a quote for a home repair and it was way too expensive. I'm just not going to do that. So if we're seeing that start to take place at the higher income levels, that could be something that is problematic. And what is also interesting, though, is the economy and the markets are two different components. And so just because you might have high earners not spend money, that does impact the economy. They also tend to be savers. And that could be good for stocks, as people are putting money into companies for kind of the long-term future growth. So those are things that we're paying attention to, there. But as we look at, again, some of the more maybe pessimistic pieces, the next slide, highlights again some things that we're paying attention to. The first is, household debt. Just like we need to pay attention to our government's debt, we need to be paying attention to the rate of increase relative to consumer debt. And we have increased. Now, this chart goes back to the 80s, and you can see we're not where we've been historically, but we have come up significantly from the post-pandemic low when, again, people received money from the government for pandemic relief. And we can debate the merits of whether that was good or bad, but what that forced a lot of people to do was actually save money and reduce their debt. And so part of the natural byproduct of that is we're starting to see debt levels rise again as that kind of safety money has been largely spent. And we're seeing that true. I mean, it's true for state and local governments. Now we're past the pandemic money that was there to help local governments and districts and things like that. And now we're being forced to make real decisions with the money that's available. The other thing that we're paying attention to is delinquencies on major parts of our kind of debt economy. So auto loans, credit cards, student loans, and mortgages. And this is something that I think is going to be a critical part to assess the health of our economy. If people are becoming more and more delinquent, we need to pay attention to that. I think what's really interesting is the student loan piece. Recently, we've student loans have started to kick back in, and so you're starting to see people, those delinquencies increase from when they were on forbearance. But now we've also seen a really sharp decline here in the first part of 2025, and so it'll be interesting to follow that and see what that means as people get accustomed to repaying loans. And then lastly, I thought what would be helpful is there have been charts being shown that people have probably seen around consumer sentiment. We're at a historic low. And this next chart we've shared with clients before, and it does underscore, if you look at the far right, that in May of 2026, we are at consumer sentiment is below where we were in even the financial crisis. It only is, there have only been a few points since the 70s since this data has been tracked that have been lower. And this is a little bit of a lagging indicator, as we were talking about leading versus lagging, in that the reason people are feeling bad is because of what they've already just experienced. And that's what's being reported here. And this is why this chart is also a contrarian positive, meaning when people feel the worst about things, when you look out 12 months, this tends to be a positive for the markets. And the top left chart shows that, if you look at the average 12-month returns from those troughs, those low points, the average return since the 70s has been just over 24%. So this could be something that is a positive as we think about the next several months. And I've shared another chart to look at this just a little bit differently, but it's the consumer sentiment, when they've bottomed, and then what those different periods have been. So you see inflation shocks, different wars, the financial crisis, COVID, 2022 with inflation and interest rates, and then you can see what those those trailing 1-year returns have looked like. So again, it is something to pay attention to. How people feel is important, but this also tends to be contrarian. And so as we think about what this means from a portfolio perspective, we wanted to share a couple things that were interesting. And this next chart looks at different decades and the top companies, but then what their 10-year average return was after that. And you can see various periods where different types of companies performed well. A lot of energy companies during different periods of time, a lot of technology companies during different periods of time. But what you can see is that there really hasn't been a through line that's more common in terms of, it's not so much who's going to be the top companies, but what we can clearly see is that after the next, looking at the 10-year, forward average return, a lot of these companies actually had negative returns. So, when we look at, current 2025, next decade, we don't know what the future holds. We know there will be winners. We know there'll be losers. And this just underscores, the importance for diversification, in that, just because a company is at the top today doesn't mean that they will continue to be at the top, moving forward. The other chart that is helpful, I think, in this is looking at just diversification and comparing bonds and stocks during market drawdowns. So again, we don't know when something will come out of left field. That's typically what causes market volatility. It's the thing that nobody knows about. And that's why we look to diversify across different types of investments. And a lot of times people think about stocks and bonds as the kind of the two ways to diversify. And I wanted to show this chart because I think it's helpful to look at different periods of time when you've got stocks down between 0 and 5, 5 to 10, or more than 10%. And in blue, you can see what the average return for the Bloomberg Aggregate Index, which is just kind of the large barometer of the bond market. It's governments and corporates, just like the S&P 500 for stocks is kind of a broad benchmark for the US stock market. And you can see there is a natural yin and yang in those various timeframes. And this is especially important for people who are in retirement, where we don't have the ability to add more money and buy low, or we need to reduce volatility because we don't want premature spend downs in portfolios. And again, there's a lot of times where the headlines make it look really easy to say, oh, just buy stocks and own stocks. But also the reality is just human behavior can cause us to do things where we make changes to the portfolio or changes to our strategy, and that ultimately isn't going to be helpful for our outcome. And so having a reminder of why we look for diversification. There are periods of time where people are like, well, why do we own stocks, or why do we own bonds? And I think this is just a helpful reminder for that. And the only other thing that we wanted to share as we head into the summer and into the fall, something that we know we're going to start getting more questions around, are midterm elections. And what this last chart shows is just looking at history from the 1930s to 2025, various forms of government. So a unified government where you have the same president and then Congress in terms of party, and then you look at split Congress, and then a unified Congress, but a different party as president. And what this shows is there really isn't that much of a difference between how the markets perform over long periods of time when you think about who's in power. So again, it doesn't mean that politics aren't important. It doesn't mean that we don't, go out and vote, and that there, aren't policies or things that, we might want to favor one way or the other. But at the end of the day, we're investing in companies, and companies figure it out. They adjust their strategies based on any number of political factors or geopolitics, and really, looked for innovation and value creation as what's going to drive, future returns. So again, a lot of times people get really, worked up, and doesn't mean that you shouldn't or couldn't, but from a financial planning, from an investment standpoint, we generally want to, make clients aware that these outcomes over time don't tend to, have a huge impact on portfolios. So obviously, we're covering a lot in a short period of time today, but if there are, questions, feel free to reach out. Happy to talk further, and look forward to sharing more insights next month.